wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 210, and in this episode we're reviewing the performance of the financial markets during the 17th week of 2026, and that is from Monday the 27th of April to Friday the 1st of May. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where a sharply divided Federal Reserve on Wednesday voted to keep its benchmark policy rate on hold as policymakers grappled with the impact of persistent inflation and awaited a looming leadership transition at the central bank. In what may have been Jerome Powell's final meeting as chairman of the Fed, the rate-setting Federal Open Market Committee voted to hold its benchmark policy rate in a range of between 3.5% to 3.75%. Amid expectations for a routine vote to keep the policy rate on hold, the committee instead witnessed a sharp division of opinions, with the vote split 8-4 in favor of the hold, with officials expressing different reasons for their decisions. And during the news conference that followed the policy decision, Powell signaled that he would remain on the board of governors for an indefinite period, saying that he was waiting until an investigation into the Federal Reserve's renovations was well and truly over. Staying stateside, according to a batch of reports released on Thursday, economic growth came out slower than expected as consumers faced escalating prices in March due to the war in the Middle East that has sent oil prices soaring and created a new level of challenge for the Federal Reserve. The Commerce Department reported on Thursday that the Core Personal Consumption Expenditures Price Index, which excludes food and energy prices and is the Federal Reserve's preferred measure for inflation, this accelerated by a seasonally adjusted 12-month inflation rate of 3.2%, which was in line with the consensus estimate as core inflation hit its highest level since November 2023. Meanwhile, the overall rate of inflation, as measured by the same index, showed that the annual rate of inflation in March came out at 3.5%, which again was in tandem with market expectations. In other economic news on Thursday, the Commerce Department reported that the gross domestic product grew at a seasonally adjusted annualized pace of 2% flat in the first quarter of 2026, and this was up from 0.5% in the fourth quarter of 2025, but was still lower than the consensus estimate for a growth of 2.2%. Over to the Eurozone, where the European Central Bank kept interest rates on hold at its April meeting, and this was despite a surge in inflation in the Eurozone that was driven by the conflict in the Middle East. On Thursday, the European Central Bank's Governing Council opted to hold its benchmark deposit facility rate at 2% flat. In a statement following the meeting, the bank said that while its previous assessment for the inflation outlook remained largely unchanged, it noted that the upside risks to inflation and the downside risks to economic growth had intensified and would depend on the intensity and duration of the current energy price shock. The Governing Council said that it remained committed to setting monetary policy to ensure that inflation stabilizes at around its 2% target rate in the medium term. Staying in Europe, preliminary data released on Thursday showed that the Eurozone economy expanded by a meager 0.1% in the first quarter of 2026 as the war in the Middle East hampers economic growth and intensifies inflationary pressures. The growth data came out alongside inflation data that showed consumer prices in the Eurozone creeping higher, with the annual rate of inflation jumping to 3% in April, up from 2.6% in the previous month of March. Over to the United Kingdom, where on Thursday the Bank of England voted to keep its benchmark policy rate on hold at 3.75%, which was widely anticipated by the markets as the Iran war continues to pose a dilemma for policymakers. The central bank was widely expected to stay put on interest rates as it waits to see how the energy price shock could reignite inflationary pressures in the UK. The bank's Monetary Policy Committee voted in an 8-1 split decision to maintain the benchmark policy rate, better known as the bank rate, at 3.75%, with only one dissenter voting for a 25 basis point hike in interest rates. Over to the Far East, where on Tuesday, Japan's central bank decided to keep its policy rate on hold at 0.75%, whilst revising its inflation estimate upwards as the war in the Middle East raises risks to the supply side. The decision to keep rates on hold came in a split 6-3 vote and was in line with analyst estimates. The dissenting members proposed to raise the policy rate to 1%, arguing that tensions in the Middle East had skewed price risks to the upside. The Bank of Japan, which is Japan's central bank, also cut its growth forecast for the fiscal year 2026 from 1% down to 0.5% and sharply raised its core inflation outlook from 1.9% up to 2.8%, and this is in contrast to the bank's inflation target rate of 2%. The central bank warned that Japan's economic growth was likely to decelerate as the increase in crude oil prices is expected to dampen both corporate profits and household incomes. On Wall Street this past week, the S&P 500 rose to a fresh all-time intraday high on Friday, boosted by Apple shares, while crude oil prices fell as a new month of trading got underway. Shares of Apple climbed more than 3% after the consumer tech giant posted a fiscal second quarter earnings and revenue that beat market expectations, overshadowing the fact that iPhone revenues fell short of estimates for the second time in 3 quarters. On the flip side, Oil prices fell after Iran reportedly sent its response to the latest U.S. amendments with regards to a draft agreement to end the Middle East conflict. The broad market index, that is S&P 500, advanced by 0.29% to end at 7,230, whilst the tech-heavy Nasdaq Composite added 0.89%, reaching an all-time high and closing at 25,114. And last but definitely not least, the Dow Jones Industrial Average slipped by 152 points to settle at 49,499. In the government bond market, Treasury yields were little changed on Friday after data on U.S. factory activity showed an expansion in April that was slightly below market expectations. On Friday, the Institute for Supply Management showed that April's manufacturing index totaled to 52.7, which was unchanged from March and slightly below the reading of 53 flat, which economists had projected. The prices paid component of the index surged to its highest level since April 2022 as companies experienced higher energy costs in the wake of the war in the Middle East, in addition to the impact of higher trade tariffs. In response, the yield on the short-dated 2-year Treasury note, which more closely tracks the Fed's policy rate, rose less than 1 basis point to close at 3.88%. Meanwhile, the yield on the benchmark 10-year Treasury bond, which is the basis for mortgage lending, this fell by 1 basis point to settle at 4.38%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions. And in related news, on Tuesday, the CEO of JP Morgan Chase, Jamie Dimon, warned that rising government debt levels could trigger a crisis in the bond market, urging policymakers to take action before the markets react to the crisis. Dimon's statement was in response to a question about whether he was worried about the rising levels of government debt around the world, and especially in the United States. For your information, global public debt reached a record high of $102 trillion in 2024 and is now approaching 100% of global GDP by the end of this decade. A bond crisis would likely mean a sudden jump in yields and a breakdown in market liquidity, where investors rush to sell and buyers recede, typically forcing central banks to step in as buyers of last resort. A recent example is the 2022 UK bond crisis, when yields on UK government bonds surged and the Bank of England had to step in to stabilize the bond market. In the commodity markets, renewed fears about the trajectory of the US-Iran war sent the global benchmark Brent crude to a 4-year high and rattled equity markets on Thursday, but analysts noted that investors remain positive and are still pricing in a peace deal between the US and Iran, but unfortunately are underestimating the potential risk for a return to a full-blown conflict. Oil prices fell on Friday after Iran sent an updated peace proposal to mediators in Pakistan, raising hopes that a settlement with the United States was still possible. Pakistani officials confirmed that mediators had received an updated proposal from Iran to end the war, and this proposal was delivered to the United States, but President Trump later said that he was not satisfied with Iran's offer. In response to the foregoing, the price of U.S. crude, that is West Texas Intermediate, fell by 3% to close at $101.94 per barrel, whilst the international benchmark Brent crude lost nearly 2% before settling at $108.17 per barrel. And in related news, the United Arab Emirates has announced that it will exit the Organization of Petroleum Exporting Countries on the 1st of May 2026. This is a major blow to the cartel that coordinates production amongst many of the world's largest oil producers, particularly those in the Middle East. The United Arab Emirates was the target of missile and drone attacks by fellow OPEC member Iran during the war, and these attacks by Iran and the closure of the Strait of Hormuz have severely constrained the country's ability to export oil, which is a key component of its economy. The UAE has the ambition to produce 5 million barrels per day by 2027 and wants more freedom in order to pursue that goal. In the precious metals market, the price of gold fell more than 1% on Friday and was headed for a similar-sized weekly loss as elevated oil prices continued to fan inflation concerns that would discourage central banks from cutting interest rates. The price of crude oil has touched double the levels seen at the start of the year, raising concerns about a global economic slowdown and higher inflation as fuel prices continue to rise. U.S. inflation accelerated in March as the war raised gasoline prices, reinforcing expectations that the Federal Reserve could keep interest rates on hold well into next year. The European Central Bank and the Bank of England left interest rates unchanged on Thursday, following similar decisions by the Federal Reserve and the Bank of Japan. Gold is traditionally seen as a hedge against geopolitical uncertainty and inflation and can come under pressure in a high interest rate environment as it loses its appeal to yield-bearing assets like U.S. Treasury bonds. In response, the price of spot gold was on track for a weekly loss of 1.2% and was last seen trading at $4,568 per ounce. And on that note, we now change scene to the Kenyan financial market, and we start by looking at economic growth in Kenya, where Kenya's economic growth moderated to 4.6% in 2025, down from 4.7% in 2024, mainly on account of slower growth in the agriculture and services sectors, which outweighed the recovery in the industrial sector. Agriculture sector growth decelerated to 3.1%, down from 4.4% in 2024, mainly reflecting the contraction of the sector in the fourth quarter of 2025 due to unfavorable weather conditions that were experienced during the short rain season. The services sector also slowed down to 5.3% compared to a growth of 6% in 2024. Meanwhile, the industrial sector rebounded in 2025 as it grew by 4.7%, supported by strong growth in construction, mining, and quarrying, and this was compared to a growth of 1.1% in 2024. And on the cost of living in Kenya, Kenya's rate of inflation jumped by the quickest pace in 7 years as it rose to 5.6% and is expected to accelerate even further on the back of costly fuel prices linked to the Iran war. Data from the Kenya National Bureau of Statistics showed that inflation surged by 1.2 percentage points in the month of April, up from 4.4% in the previous month of March. The jump in inflation is linked to the high cost of fuel prices following the war in the Middle East, which saw petrol and diesel prices rise by 10.8% and 17.9% respectively. Fuel prices have a significant impact on inflation in Kenya, which relies heavily on diesel for transportation, power generation, and agriculture, whilst kerosene is used in many households for cooking and lighting. The monthly increase in inflation by 1.2 percentage points is the largest increase since 2019 and is likely to shake up the economy and present a new headache for the central bank, whose primary responsibility is to maintain low and stable prices. In the domestic foreign exchange market, the Kenya shilling was broadly flat versus the US dollar this past week, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.19, and this is compared to a rate of 129.21 that was recorded the previous week. Meanwhile, the sterling pound was priced at 174.13 and the euro was valued at 150.99. And on the regional front, one Kenya shilling was changing hands for 28.81 Ugandan shillings and 20.08 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.31. The International Monetary Fund has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by just $13 million for a grand total of $13.22 billion, which is equivalent to 5.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained well funded and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained static at 8.75%, which is in line with the current central bank rate at the same rate of 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 54.6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 30th of April, and the central bank received bids totaling to 18.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 77%. The central bank accepted almost the entire amount offered, and the results of the auction were as follows. The 91-day rate increased by 26 basis points before settling at 8.03%, whilst the 182-day rate shot up by 32 basis points to average out at 8.21%, and the 364-day rate also inched up by 24 basis points to top out at 8.51%. For your information, just last week, the Treasury bill market appeared to be reversing its downward trend, and this was on the back of the first supplementary budget for 2025-2026, which pointed to an increase in the domestic borrowing target. And with inflation now above the midpoint of the central bank's target range, we can expect upward pressure on interest rates to persist in the short term due to the conflict in the Middle East and its impact on fuel prices. In the corporate bond market, I&M Bank has signaled a preference for high net worth investors by setting a relatively high minimum investment amount of 500,000 shillings for its corporate bond, in which it is looking to raise a total of 20 billion shillings that will be used to grow its loan book and boost its capital levels. The bank intends to raise 10 billion shillings in the first tranche of the bond, which runs for 2 weeks until the 15th of May, and has retained the option of taking an additional 3 billion shillings in case of an oversubscription under what is referred to as the green shoe option. I&M Bank is offering investors a return of 12.2% on this bond, which will be listed on the Nairobi Securities Exchange on the 21st of May 2026. The bank plans to use the funds to grow its loan book and also to increase its total capital level. For your information, the minimum core capital for banks rose to 3 billion shillings in December 2025, and this is in line with the Business Laws Amendment Act of 2024 that requires Kenyan banks to progressively increase their minimum core capital from 1 billion shillings up to 10 billion shillings by December 2029. Up next is our topical issue, and this week we're looking at the World Bank's conditions for Kenya to access a loan of $750 million. The World Bank has cited 3 conditions that Kenya must meet before it unlocks a loan of $750 million, which is equivalent to about 97 billion shillings, and this is in relation to the economic shocks triggered by the war in the Middle East. The World Bank reckons that it will release the funding once Kenya has fulfilled the following 3 conditions. The first condition is that Kenya needs to pass regulations indicating the criteria it uses to determine the beneficiaries of monthly stipends that are offered to orphans, the elderly, and persons living with disabilities. The second condition is that Kenya also needs to put in place regulations guiding the issuance of sustainability-linked bonds. And the third condition is that Kenya needs to put in place a legal backing to a policy that obligates the country to raise its tree cover to at least 30% by 2032, and this is part of the Forest Conservation and Management Act. The total funding amounting to $750 million is offered as a budgetary support loan through the World Bank's development policy operations. And as it stands, if Kenya fails to meet the set conditions, then it runs a risk of missing out on World Bank funding for the second financial year in a row, and this could put the country in a dicey situation, especially with potential foreign investors. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, we cannot become what we need to be by remaining who we are. A quote by Oprah Winfrey. Think about it. Thank you, and God bless.